Passive investment vehicles have grown in popularity over the last few years, but is a passive strategy always appropriate? Passive investing generally refers to a strategy that tracks an index, but which index should you track? There are 43,000 public companies globally and over 3 million indices, so where do you start? Well, you could decide to own every stock in the world with an exchange-traded fund or ETF that mimics the global market cap distribution. But this would mean that 45% of your exposure is in international holdings. Is that best for you? Probably not if you're based in the US and have dollar-denominated liabilities. So what about just owning an ETF that tracks the S&P 500? It would be more prudent to diversify with international and small company investments, but how much of each? Even after deciding proper allocations, you must decide which passive vehicles to use. Do you use an ETF that tracks a Russell index or an S&P index? An MSCI or a FTSE index? Behind each of those index providers is a group of people actively deciding which companies to include in the index. Even two similar passive investments may have vast differences. For instance, both MSCI and FTSE offer emerging market indices. However, MSCI considers South Korean companies to be emerging, while FTSE considers them to be developed. This small difference leads to large variances in performance. The second reason we predominantly use active investing is because it allows for better control of risk. With a passive investment, you have outsourced that control. Passive investments may be more concentrated than you think. The top 5 companies in the S&P 500 make up 15% of the index. Concentrated positions can create higher risk and lead to liquidity concerns. Furthermore, passive investments buy the index without considering valuation or growth, both of which are important in determining whether an investment is appropriate. We have seen an explosion of passive ETFs since 2009. ETF assets have grown from $700 billion to over $4.5 trillion. But this has occurred during a 10-year bull market. We have not witnessed how passive investment vehicles would perform in challenging or extended bear markets. Active management has allowed us to mitigate downside risk at market inflection points, like the dot-com bust in 2000 and the financial crisis in 2008. Finally, active management offers a way to exclude particular types of companies, such as fossil fuel, weapon, tobacco, or gambling companies, or any investment that does not align with your beliefs. None of this is to say that we believe there is no room for passive investments in a portfolio. To the contrary, we think passive ETFs are a great tool to complement active management. However, for the core of our client portfolios, we find great value in using active investing to select individual stocks and bonds.